Let me begin with an uncomfortable confession. What is happening in the United States with protectionism doesn't surprise me in its political logic, although its economic consequences deeply alarm me. And I say it doesn't surprise me because I myself warned, almost 250 years ago, that free trade would always be the most difficult policy to sustain politically, precisely because its benefits are diffuse, reaching millions of consumers in the form of lower prices, almost invisibly, while its costs are concentrated and brutally visible. A factory closing, a city emptying out, 10,000 workers losing their jobs in the same month. That political asymmetry is the Achilles heel of free trade, and protectionists have skillfully exploited it in every generation. But having said that, let me be absolutely clear about the massive tariffs the United States has imposed, both during the Trump administration and in the policies that continued under Biden, and have since deepened. They are an economic mistake of the first magnitude, disguised as industrial patriotism. What is a tariff in essence? It is a tax that a country's government levies on its own citizens for buying foreign products. It is not paid by the Chinese exporter, it is paid by the American importer, and that cost is passed on to the American consumer. When the United States imposes a 25% tariff on Chinese steel, the immediate result is that steel becomes more expensive for all American manufacturers who use it: construction companies, automakers, appliance manufacturers. And those additional costs end up in the final price paid by the average citizen. In redistributive terms, it is a regressive tax. It disproportionately affects those who spend a larger portion of their income on consumption, which are precisely the lower-income workers that protectionism claims to defend. Now, the argument I hear most often is that of national security, that the United States cannot depend on China for semiconductors, pharmaceuticals, critical minerals, or military technology. And here I must be honest, that argument carries more weight than I would be willing to concede under normal circumstances. I myself acknowledged in The Wealth of Nations that defense is more important than opulence, and that there are strategic industries that warrant some protection, even if they are economically inefficient. The British shipbuilding industry of my time was an example I cited directly. But having said that, there is a vast difference between surgically protecting genuinely strategic industries for reasons of national security and launching a generalized tariff war against the world's largest trading partner, with simultaneously contradictory objectives: protecting manufacturing jobs, reducing the trade deficit, disciplining China geopolitically, and revitalizing abandoned industrial cities. None of these goals is efficiently achieved with generalized tariffs, and combining them all produces an incoherent policy that creates more distortions than it solves. What worries me most is the escalating logic. A trade war has no natural endpoint. Each round of tariffs generates retaliation, which in turn generates new tariffs. The Iowa farmer who exported soybeans to China and suddenly lost that market when Beijing retaliated didn't benefit from industrial protectionism. He was its collateral victim. And that farmer needed federal subsidies to survive, meaning the American taxpayer paid twice: first in the form of higher prices for imported goods, and then in the form of taxes to compensate those harmed by the trade war. My final diagnosis is this: American neo-protectionism is not a coherent economic policy. It's a political response to real social discontent, the decades-long neglect of the industrial working class, but implemented with instruments that don't resolve that discontent and impose additional costs to society as a whole. The real problem wasn't free trade itself, it was that its gains were never redistributed to those who bore the brunt of its adjustment costs. That was the political failure. The tariffs are the price we're paying now for that decades of negligence. This question requires an honesty from me that may surprise those who cite me for any form of globalization without nuances. In aggregate terms, the answer is that the international division of labor and the offshoring of manufacturing to Asia did increase America's total wealth, measured in terms of GDP, productivity, and consumer access to cheaper goods. A middle-income American in the year 2000 could purchase clothing, electronics, and consumer goods at prices that would have been unaffordable a generation earlier. That is a real benefit and should not be minimized. But the question you ask me is finer than that, and I answer it with equal honesty. That added benefit was deeply unequally distributed, and the costs of adjustment fell disproportionately on the industrial working class of specific regions, the so-called Rust Belt, the Rust Belt of the Midwest and the Northeast, while the gains were concentrated on the shareholders of the corporations that offshored, on high-income consumers, and in coastal regions linked to the knowledge economy. There's something economists call the China shock, rigorously studied by David Author and his colleagues, that quantifies this with disturbing precision. American counties most exposed to Chinese manufacturing competition did not recover in the way conventional economic theory predicted. Displaced workers did not migrate to new industries with similar wages. Many fell into chronic unemployment, significantly lower wage service jobs, dependence on welfare programs, and higher rates of addiction and family breakdown. That was not in my 18th century models, and I must admit it. Why did this happen? Because I assumed, and classical economic theory inherited that assumption, that productive factors, especially labor, are mobile, that the worker who loses his job in the steel factory in Pittsburgh will find another in the service industry in Charlotte, or in the technology industry in Austin. But real labor mobility has enormous frictions that I underestimated. People are rooted in their communities, their families, their social networks. A 50-year-old worker in a mono-industrial city does not easily rebuild his life in another city, even though theory says he should. And here is the political error that had historical consequences. The economists and governments that promoted globalization presented aggregate gains as if they were distributed automatically, without designing serious redistribution and reconversion mechanisms for those who lost. When free trade theorists said the economy as a whole wins, they were right in technical terms and profoundly negligent in political terms, because that economy as a whole was made up of real winners and real losers, and the losers had names, addresses, and votes. We see the political result of that negligence today. The rage of the white industrial working class that fuels protectionist populism is in part a rational response to a real abandonment. I do not share the solution they propose. Tariffs will not return those factories or those salaries, but I perfectly understand the discomfort that causes it. And part of the responsibility lies with those who promised that globalization would benefit everyone without building the mechanisms to make that true. I don't justify it. I want to start with that clarity. I assign the government three legitimate functions: national defense, the administration of justice, and public works and institutions that the market doesn't efficiently provide because they aren't profitable for private capital but are necessary for society as a whole. Nowhere in my writings, nowhere in The Wealth of Nations will you find a fourth function that says to transfer wealth from taxpayers to private corporations that have taken excessive risks and gone bankrupt.
The 2008 financial bailout, the TARP programs, the Federal Reserve programs, the effective nationalization of AIG represents exactly the kind of policy I most vehemently denounced when practiced by medieval guilds or colonial monopolies. The socialization of losses while profits remain private. Wall Street banks took extraordinary risks for years, paid their executives obscene bonuses based on profits that turned out to be illusory, and when the system collapsed, they turned to the state, the American taxpayer, including the workers who lost their homes in that very crisis, to absorb the losses, and the state gave them that bailout. That's not free market capitalism. It's what is now accurately called crony capitalism, and it's exactly what I warned would happen when corporate interests capture the regulatory and legislative apparatus of the state to protect themselves from the consequences of their own mistakes. The too big to fail logic that justified those bailouts strikes me as particularly pernicious. If a company knows that the state will bail it out when it goes bankrupt, the most important disciplinary mechanism in the market, the risk of loss, disappears. In my system, bankruptcy is not a tragedy. It is the signal the market sends to those who have misallocated resources, urging them to reallocate those resources to more productive uses. When the state eliminates this possibility for large corporations, it creates a system where risk and reward are disconnected, and this disconnection is the perfect recipe for systemic irresponsibility. Regarding the most recent industrial subsidies, the Inflation Reduction Act, the CHIPS Act, the billions in incentives for semiconductors and electric vehicle manufacturers, the answer is more nuanced, and I must be intellectually honest about it. There are arguments I recognize as partially legitimate: the positive externalities of technological research, the strategic need to avoid dependence on a geopolitical adversary for critical technologies, or the correction of market failures, where short-term private profitability is insufficient for long-term socially necessary investments. But even when I accept these arguments in principle, I deeply distrust the capacity of the political process to implement them efficiently and without corruption. Who decides which industries deserve subsidies? Lawmakers, who receive campaign contributions from those very same industries. Who evaluates whether the subsidies worked? The very agencies regulated by the corporations that receive the money. The distance between industrial policy with legitimate strategic objectives and distributing public favors among well-connected interest groups is much shorter than their proponents admit. What is happening in the United States is a dangerous confluence. The state expands its role in supporting private capital, corporations expand their capacity to influence the state, and the taxpayer and the consumer foot the bill for both processes simultaneously. That is not the free market I theorized. It is its most sophisticated negation.
This question raises a concern for me that few economic figures have managed to do, and I have seen many alarming figures in my life and in what I've been able to study of subsequent history. Let me begin with the context I myself established regarding public debt. In The Wealth of Nations, I was one of the first to systematically warn about the danger of accumulated public debt. I observed how European governments, especially the British, financed wars and current expenditures with debt, trusting that future generations would foot the bill for present commitments. I called it an unjust transfer between generations, and I warned that no nation in history had managed to pay off its public debt in an orderly fashion. It always ended in either explicit default or inflationary devaluation, which is a disguised default. $34 trillion, more than 120% of U.S. GDP, is a figure that surpasses anything I could have imagined in absolute terms. But absolute numbers can be misleading.
What matters is the relationship to the economy's productive capacity, and above all, the cost of servicing that debt relative to government tax revenues. And here's the problem that seems most urgent to me. For decades, with near zero interest rates, the United States was able to accumulate debt at a relatively manageable fiscal cost. That period is over. With higher interest rates, a necessary consequence of the inflation that followed the massive monetary expansion, the annual cost of servicing that debt has already exceeded $1 trillion. To put it in perspective, the American government spends more on paying interest on its debt than on its defense budget. That's not sustainable indefinitely. I identify 4 specific risks that concern me, listed from least to most serious. First, the crowding out of private investment. When the government borrows in capital markets on a large scale, it competes with the private sector for the same available funds, raising interest rates for everyone. Companies that would have invested in new machinery, research, or expansion are not doing so because credit is becoming more expensive. This crowding out, what economists call it, stifles long-term productivity. Second, vulnerability to external shocks. An economy with low debt has fiscal space to respond to a crisis, a pandemic, a recession, a war, with additional spending without compromising its solvency. An economy already operating with debt equivalent to a year of its total output has that space severely limited. The next major shock will find the United States far less prepared than it was in 2008 or 2020. Third, dependence on foreign creditors. A significant portion of American debt is held by foreign governments and central banks, China, Japan, and Saudi Arabia among the main ones. This creates a geopolitical vulnerability that I find particularly ironic. The same country waging a trade war against China for national security reasons is simultaneously dependent on China to continue buying its debt to finance its public spending. This contradiction cannot be sustained indefinitely. And fourth and most serious, the risk of a loss of confidence in the dollar as the global reserve currency. The extraordinary privilege the United States enjoys, the ability to borrow in its own currency without the exchange risk that affects other countries, rests entirely on global confidence that the dollar will maintain its value and that American debt is the safest asset in the world. This confidence is not a fact of nature, it is a historical convention that can erode. If global markets were to seriously doubt American fiscal solvency, something that seems remote today, but that each credit rating downgrade and each debate about the debt ceiling brings a little closer to reality, the consequences would not be limited to the United States. A crisis of confidence in the dollar would be the most disruptive economic event since the Great Depression, because the entire global financial system is built on that confidence.